Okay, if you're building, operating, or even just investing in software today, you really need to listen up because the scoreboard has completely changed. The old playbook, it will literally bankrupt you now. So, welcome to this explainer. Today, we're unpacking the single most critical financial shift hitting the SaaS world in 2026, the burn multiple, and exactly why the smartest investors in the room are drawing a hard line in the sand and demanding a ratio of 1.0x or less just to take a meeting. Let's dive in.
To really understand why this massive shift is happening, I want to start by hitting you with a pretty jarring number straight from the data: $2. Right now, the median SaaS company spends exactly $2 just to acquire one single dollar of new annual recurring revenue. Think about that for a second. Think about what that does to your lifetime value versus your customer acquisition cost. When it takes 2 full years, basically, just to break even on the cash you burn getting one user to sign up, well, any slight bump in churn can be fatal. In that $2 figure, it's actually up 14% since 2023, painting a really vivid picture of a market where acquiring customers has become painfully and sometimes prohibitively expensive.
So, when you're consistently burning twice what you bring in just to get a customer through the front door, you're eventually forced into a corner to ask yourself a very serious question about survival. Is growth at all costs dead? The short answer? Yes, absolutely. The whole era of buying market share at infinite losses is totally over. What replaced it is much more ruthless, and it demands a completely new level of operational rigor from anyone sitting in the C-suite today.
Which brings us to our first major shift, the death of hypergrowth and the paradigm shift of 2026.
This brilliantly illustrates the contrast. We have officially transitioned out of the cheap capital era of 2021. You remember back then, right? Burning 3 times your revenue was perfectly fine. It was often encouraged. As long as your top-line growth was soaring, money was virtually free. But fast forward to 2026, and the environment is fundamentally different. Efficient growth is an absolute mandate now. The companies actually winning today are still growing fast, often north of 25% a year, but they're doing it while burning significantly less cash. The market doesn't reward you just for moving fast anymore. It rewards you for moving fast, efficiently.
And this is largely being driven by a massive squeeze on cash reserves due to skyrocketing customer acquisition costs. We're talking a surge to a median of $1,200 per customer. There are a few major culprits here. First, digital ad costs have just exploded. Platforms like Google and LinkedIn are vastly more expensive and totally saturated. But beyond just the marketing side, buying committees in B2B have grown so much larger and way slower. CFOs are putting every single software subscription under a microscope, extending sales cycles and demanding way more touchpoints and demos to close the exact same deals that used to take weeks just a few years ago.
So, to measure who is actually surviving this crunch, the industry crowned a new hero metric. Let's meet the burn multiple.
The concept here is brutally simple. The burn multiple measures exactly how much cash you're burning to generate one single dollar of new annual recurring revenue. You just take your net cash burn and divide it by your net new ARR over that exact same time period. So say you burned $5 million in a quarter, but you added $4 million in net new ARR, your burn multiple is 1.25x. It's beautiful because it strips away all the accounting noise and tells you exactly how efficient your growth engine really is.
And look, this isn't just some niche accounting term meant for internal spreadsheets. Top-tier venture investors, guys like David Sachs at Craft Ventures, who actually helped popularize this whole framework, they rely on the burn multiple as the single best indicator of efficiency during growth phases. This is the shorthand metric the entire market uses to judge your capital discipline, your management competence, and your overall health before they even think about writing a term sheet.
That leads us straight into the 1.0x investor mandate and why capital discipline is basically the only way you win today.
The data here is pretty wild. It shows an overwhelming majority of late-stage investors now prioritize this exact discipline. 56% of seed investors already call it critical. But look at the later stages. A massive 83% of Series C and later stage investors explicitly demand a highly optimized burn multiple. On top of that, 94% of the elite Cloud 100 companies are actively aiming for strict profitability. The takeaway? Growth rate alone simply doesn't drive term sheets anymore. If you pitch 100% year-over-year growth, but your cash efficiency is terrible, you're going to get passed over for the company growing at 40% with rock-solid unit economics.
So here is the crucial warning sign you need to watch out for. If you're past $10 million in ARR and you are still spending $3 to make one, meaning your burn multiple is 3.0x or higher, you have a massive, potentially fatal problem. Sure, that kind of burn might be somewhat acceptable if you're a pre-product market fit startup just figuring things out. But at scale, spending $3 to get $1 in the door means you're basically buying revenue at an unrecoverable loss. Now, this ties directly into the Rule of 40, the idea that your revenue growth rate plus your profit margin should equal 40% or higher, while the harsh reality in 2026 is that the median SaaS company is actively failing this test, sitting at a score of just 28%. But here's the upside. Those who actually balance growth and profitability correctly, the elite tier scoring above 60%, they are literally tripling their valuation multiples compared to their inefficient peers. Efficiency directly translates into massive enterprise value now.
Okay, let's get into a diagnostic breakdown and look at your exact 2026 efficiency benchmarks.
Honestly, you might want to take a screenshot of this one, because this outlines the exact acceptable targets broken down by your funding stage. At the seed level, a multiple of 2.5x to 3.4x is expected because, well, you're building the initial product. But notice how aggressively it tightens up? By Series A, you need to be at 1.2x. Growth stage companies are targeting 1.4x, with the absolute best already running under 1.0x. And at the late stage, crossing that $100 million ARR mark, anything over a 1.0x burn is completely unacceptable to public markets and late-stage PE.
So how do you actually bring your burn rate down to hit those aggressive numbers? It all comes down to headcount efficiency. Top performers are squeezing incredible operational output from their teams, targeting anywhere from $150,000 to $250,000 in revenue per employee. It's not about making people work 100-hour weeks. It's really about utilizing the right systems, cutting out managerial bloat, and maximizing the revenue generated by every single person on your payroll. But wait, how are the absolute best companies completely crushing those benchmarks? That brings us to the AI efficiency advantage, a massive structural shift. This visual brilliantly lays out the gap we're seeing in the market right now. AI-native SaaS companies are running incredibly lean, achieving burn multiples between 0.8x and 1.2x. They are significantly outperforming traditional software models, which are stuck closer to 1.4x at the growth stage. And you have to understand, this isn't just a minor incremental improvement. It is a fundamental structural advantage in how these new companies are being built from the ground up. So, how exactly are they pulling this off? By relentlessly automating massive chunks of their core operations. Take customer support, for instance. AI-native companies are using advanced LLMs to handle up to 60 or 70% of Tier 1 support tickets with zero human intervention. In engineering, tools like GitHub Copilot are allowing teams of 5 developers to push out the work that used to take 10 or 12 people. By compressing these operating costs, they sustain top-line revenue growth while keeping incredibly healthy margins. It basically extends their runway indefinitely and makes every dollar of investor capital work so much harder.
As we wrap up this explainer, I want to leave you with one absolutely critical question to ask yourself heading into the rest of 2026. Are you just burning cash, or are you actually building an engine? If you're still running that 2021 playbook, just optimizing for top-line growth without checking the unit economics underneath, the market is telling you, very loudly, that the rules have changed. Efficiency isn't the enemy of growth anymore. It's the enabler of faster, healthier, and way more resilient growth. Calculate your burn multiple today, benchmark it, and start building that engine.